Hey guys, this is Dave, and we're back with another video talking about investing and trying to make some money together. If you're new to the channel, I hope I earn your subscription by the end of the video, and if you're not, welcome back and thanks for continuing to subscribe. So today what we're talking about is 3 stocks I'm buying now. That's 3 stocks I think are a good deal and will make me money in the future. So let me know what stocks you think are a good deal right now, what you're buying, if you think these ones are good, or if you have any other ideas down in the comments below. And with that, let's hop over to the analysis of these stocks. All right, so number 1 stock to buy now, or at least I am buying now, is Tesla. If you've been watching the channel, this is probably no surprise to you. Sorry to sound like a bit of a broken record here, but I just think at these levels, anything below 700 especially is an extremely great deal. We're talking here about a company that is growing extremely quickly. They are guiding for 50% increase in annual vehicle productions per year for the next 5+ years. So that is exponential growth there, not just linear growth. And that's not even to get into the massive potential of full self-driving, robo-taxis, their humanoid robot, their storage business, energy business, solar tiles. There's so many other factors here. But regardless, as we can see, they've dropped quite significantly over the past year. We're looking at a 1-year chart right now. They've gone from over $1,200 a share to $700 a share. That's pretty much 50% drop from their heights. Now, during this time, they've continued to grow production, and a lot of these drops can be attributed to the macro markets, where all the high PE multiple stocks are being absolutely crushed right now. But what this is doing is crushing the multiple at this point. So we've gone from a multiple of over 300 price to earnings to something like 70, and that will continue to drop extremely quickly. There's only so far the multiple can drop before the stock has to start rising. It just won't make sense at that point to give it a low multiple if it's still growing that quickly. If we take a quick look at the revenue and operating income chart, so I always like to look at this, not just big picture, but let's look at the numbers. You can see revenue has been going extremely quickly for the past 2+ years. As well, we're making profit, which has been ramping up steadily, and operating income is ramping up steadily. There's no longer any concerns with this company when it comes to debt or potentially going out of business. That's just not going to happen at this point. They have an extremely solid balance sheet. And they have dropped quite recently because of a few tweets and pieces of news, which I think are a little bit misunderstood. So we had a big 9% plus drop on Friday after news came out that Elon Musk sent out this email. So what he said is, Tesla will be reducing salaried headcount by 10% as we have become overstaffed in many areas. Note this does not apply to anyone actually building cars, battery packs, or installing solar. Hourly headcount will increase. So it's really the second paragraph that I think that was getting lost by many people, and the focus was, oh no, Tesla's cutting staff, things must be going poorly. But really what they're doing is, forgive me for if anyone watching this worked at Tesla and got laid off, but cutting the fat, as it said, where the people actually building the vehicles, building the solar, are growing, and what they're really reducing is their management and office staff who are not actually building the products, which is frankly good for margins, because the less amount of people you can have in the back office, the more lean and profitable a company you can have. These are people that are not directly involved in building the products. So the growth of their factories, the growth of their products is not going to be cut by these headcount reductions that a lot of people seem to be missing and misinterpreting. Just to highlight a tweet that came out recently, it's crazy the amount of news we get from Twitter these days, but that's just kind of the world we live in. So the Q1 2022 operating expenses, Tesla spent $1.9 billion, which sounds high, but Rivian, a competitor, is spending $2.1 billion in operating expenses. So Tesla, the massively larger company, growing more quickly, way more vehicles, footprint all around the world, is spending less on operating expenses than Rivian, and we're still trying to crush this down even further and be as efficient a company as possible, keep those operating expenses low and the profits higher as a result. Also, bullish news here is full self-driving software is getting better and better. A lot of people don't really pay attention to it and don't realize how good it is getting. It's now going to be rolling out to 100,000 new customers who will have access to this full self-driving software, and simultaneously will be training the software every time they take over from the full self-driving software and make a disengagement. The software learns, okay, I must have done something wrong there. Let's look at what we did wrong. They should be able to recognize some of that revenue, which they have not been able to recognize at this point as they roll this out to more and more people. There's also talk of getting it licensed in the EU, which has not been done up to this point recently. And I've just anecdotally heard a lot of comments from people using the software out on Twitter and YouTube and social media that it's getting a lot better lately. I've watched people driving it. They say it feels a lot smoother. It feels a lot more confident, a lot more human-like. So good progress is definitely being made there, and that's an aspect of the business that a lot of people seem to be completely forgetting about when they make their financial models. They just don't know how to model for it, and so they just ignore it, which, you know, is at their own peril, I think. So Tesla is another company, $700 or lower. I've been buying aggressively this past week and will continue to where I can because I think it's just a great deal. Supporting today's video, we have a referral link down below for Interactive Brokers. It is the trading platform I use myself. I wouldn't recommend it to you if I didn't think it was good. They offer extremely low margin interest rates if you like to invest and trade on margin, extremely advanced tools in their trader workstation platform, and of course, their transaction fees are some of the lowest around. So if you do use the sign up link down below, you'll receive $1 of free Interactive Brokers stock for every $100 you deposit, and you will be helping to support the channel. Please do consider hitting that link down below if you're interested in a new trading platform. Thanks. Long run. Number 2 is Rocket Lab. I recently came out with a few videos on it, so if you want a full breakdown, I suggest checking out the past few videos. But just for a brief refresher or brief summary if you didn't see them, their order backlog is growing massively. So they had a $241 million order backlog in just Q4 of 2021. Then in the next quarter, Q1 2022, it went up to 546 million. So that's more than doubling in just a single quarter. Usually, doubling your backlog in a year would be great, but doubling it in a quarter is kind of unheard of. And then when they reported their earnings not long after that, it had gone up even more to 555 million. So lots of customers there. The order backlog is increasing. You love to see it as a shareholder of Rocket Lab. Also, their revenue and gross margins have been increasing steadily. So this is from recently Q1 2022 quarter results. We have 124% year-over-year revenue growth, and the margins are expanding rapidly. They're still not a profitable company, so definitely a bit more speculative, a bit more risky, but I've gone through the numbers and the projections, and I'm pretty confident in this company, especially with the management. Peter Beck is a fantastic CEO. I have a lot of confidence in him. I've followed him pretty closely for the past few years. And looking in the charts below, they have their launch business and their space systems business. We did have a bit of a bump in the road due to COVID for their launch business. They didn't have as many launches this past quarter as they usually do. That is going to ramp back up, and the space systems business has been growing extremely rapidly through in-house organic growth, as well as several important acquisitions where they will make satellites and satellite parts for other companies. So we went from just a little sliver, $1.7 million in Q1 of 2021, to in Q1 of 2022, $34.1 million. Small company for sure, but growing rapidly. Also, big news for the company was they were successful in catching their Electron rocket after launching to orbit. So, massive step forward in terms of becoming more profitable and being able to reuse their rockets. Currently, the only company in the space launch market that can reuse rockets is SpaceX, which is an absolute beast of a company valued at, last I heard, I believe it was $105 billion, whereas Rocket Lab is valued under $3 billion at this point. So unlocking the potential of reusable rockets is extremely important, and this was a very good sign for the company. They're getting very close to being able to reuse their Electron rocket. So I went through the numbers recently in a previous video, stock analysis video. If you didn't watch it, I highly suggest checking it out as I go into a lot more details. But basically, I've went through their projections for the next 5 years out until 2027. Now, a lot of things can change. They may not execute on their plan, but from my estimation, giving it, a fairly conservative multiple, I think, really, in terms of their earnings multiple, I see a potential 5x return in the next 5 years. So extremely large return potential if they can grow the business and become profitable in the next 5 years, if Peter Beck can guide them and successfully execute on their plan. Now, number 3 is Airbnb. We see the stock chart here is just like every other tech growth company. They have been hit hard. They've gone from over $200 a share to around $100 a share. So that's, basically a 50% loss, which is what we're seeing in a lot of these companies right now, which I believe makes it a good time to be adding some shares. This is pretty much the lowest you've ever been able to add shares of Airbnb since it went public a little over a year ago. And for a lot of this time, it has been a little bit expensive, but I think right now it's a good buy. So I've taken some notes from recent earnings calls as I've been researching this company, things that I think are noteworthy. Number 1, they have a very strong balance sheet of $9.3 billion. They're not really in any danger of going out of business, of not being able to invest in the future. They're still growing rapidly. They can make acquisitions if they want to, although that's not their primary means of growing their business. They have the money to compete with their competitors in terms of advertising and investing in R&D. Their new experiences section of the company, where they will be offering, experiences and as opposed to just places to stay, kind of like tours or places to go, things to see. What the CEO said about that in the last earnings call was that this year they're planning to see moderate growth on experiences, but next year they'll be going full throttle on the experiences ramp, and it will be bigger than most people think. A lot of people want to get back out, experience the world. They're tired of being locked up due to COVID. They're ready to travel. They're ready to have new experiences and not just stay at home and, be on their computer and do things virtually. In terms of margins, from the CFO, we heard him say, we're very proud of the progress we made in our margins in 2021. I mean, we increased them from minus 5% back in 2019 to 27% in 2021. So we really do want to see this company transition from a growth, money-losing company to a money-making machine, which I think is very possible. I think this business model lends itself very well to extremely high margins, where they just run a platform matching the customers with the hosts and take a fee out of every transaction. So I really think that should lend itself to extremely high margins. They don't have to worry about actually building these properties and running them themselves. And it's just a matter of continuing their growth and cutting back on some costs. We also heard that adjusted EBITDA margins increased 45 percentage points from negative 30% in Q1 2019 to positive 15% in Q1 2022. So that's about 3 years. They went from negative 30% to positive 15%, so a 45% increase. Relative to Q1 2021, adjusted EBITDA margins increased 22 percentage points from negative 7% in Q1 2021 to positive 15% in Q1 2022. Now, these numbers might be skewed slightly because of the outsized impact the pandemic had on their business. It is a travel business, obviously. So when we're shutting down due to a certain virus, that had a massive impact on their business. But they were able to weather this storm extremely impressively, and now they're coming out even stronger. We're seeing travel demand beginning to roar back. You see it on the airlines. You see the cruise companies now doing business again, and it's really picking up for Airbnb as well. People are tired of staying inside. They're ready to get back out there, and they've even saved up some money over the past few years where they haven't been able to travel. They also, on May 11th, I believe, announced a big redesign of their app and website. CEO Brian Chesky calling it one of their biggest redesigns ever. They're redesigning their search, allowing you to do split stays in a single trip where you can schedule stays at multiple locations on your trip, changing the UI for the app and their website. So a lot of big things happening for Airbnb right now. I think it's a good buy. I think there's no major threats to their business. They are continuing to grow rapidly. And this type of business, kind of like gatekeeping, where you're running a platform and taking a cut, a lot like Apple's App Store business, where they just run this platform and take a cut from every single person who posts on it. Apple is making money hand over fist on that model. And I think Airbnb, if they do it right, can be extremely profitable using this same model. All right, now let's head back and wrap up our buys. So to wrap up, my 3 stocks that I'm buying right now are Tesla, Rocket Lab, and Airbnb. And how I look at these is I think Tesla is probably my highest conviction name. I think they're going to do extremely well in the future and continue to grow aggressively. At some point, I truly believe they very well could be the largest company in the world, which means we're looking at, from these levels, potentially a 2x or 3x return. They do execute on robotaxis, real-world AI, and their humanoid robots. Really, the sky is the limit for this company. In terms of Rocket Lab, it's probably the most speculative. It could be the most risky. Their cash position is pretty good right now. They're not making money, though, as of yet, and this market environment is not rewarding companies that are not yet profitable. So it's possible it could be in for another painful few months. But in the long term, I think I might see the highest potential return for them as a 5x plus, potentially even going up to a 10x over the next 10 years or so. They execute on their new Neutron rocket, on rocket reusability. Their space systems line of business continues to grow, and reusing rockets will unlock so much more potential for the company. Airbnb, I think, can be an extremely lucrative business. They're continuing to grow. They're continuing to improve their margins rapidly. I love their CEO, Brian Chesky. He is the founder of the company. And it's another one that I think is a good buy right now. A little bit safer than Rocket Lab, but I would say the potential return does not have quite the same high ceiling. So those are the 3 stocks I'm buying right now. Let me know down below in the comments. What do you think of these companies? Who are you buying right now? Or are you even selling? Thanks for tuning into this video. If you enjoyed, please consider hitting like and subscribe, and I'll see you next time. Thanks. Bye.